Mark, let's find out what's top of mind for you. We're working towards a Fed meeting, of course. Markets seem pretty peaceful with that still on the horizon. But you're spotting some dollar softness that you're putting down to the Miran story. Are we back to talking about steepness and dollar softness on the back of that then?
We very much are talking about that. I think one of the problems going into this week's Fed meeting, which is what everyone is eyeing, is that the trades have already played out. We've pre-priced this Fed very aggressively, both from the bond side and the stock side. I think the narrative is now clear, and it's that, you know, with the administration pressure, with the appointment of Stephen Miran, with the fact that they're trying to fire Cook, that we're going to get more dovish monetary policy than orthodox economics would suggest, and that's a narrative likely to run. So but markets are already pricing that in via a sharp collapse in yields and through very bullish stock market, which makes the risk reward of playing it further post the Fed much more difficult. No reason to go against it, but there's a risk of that kind of little buy the rumor, sell the fact event. The one theme that's probably got a little bit more sustainability is dollar weakness. That's the one trade that's had very little kind of correction all year. It's been a very safe trade to play, and whatever the administration is doing, it is undermining US institutional credibility, and that is bad for the dollar.
Mark, what are your thoughts on emerging markets then? That sounds like a pretty, I guess the scenario you laid out sounds like a pretty decent trajectory for emerging markets to outperform. Is that your case?
Absolutely. So the dynamic is we're getting easy monetary policy. We're getting a bullish environment for stocks. Basically, what the Fed is doing, what the administration is forcing the Fed to do, is to juice markets in the short term to create longer term risks. But they're still being juiced in the short term, which is why you don't want to fight it. And we're also getting an easing of the dollar, which is an easing of financial conditions to the rest of the world. It is a great environment for emerging markets. We're seeing that dynamic play out. Emerging markets have been doing wonderfully all year. They've been outperforming the US, and I expect that to be a theme to continue. And really important to emphasize, this is not just about China outperformance, which has happened. It's about global EM generally. There's a little bit more idiosyncratic stories, but many countries around the world are really outperforming the US.
Mark, if the White House is successful in its takeover of the FOMC, are we going to see more creative ways of managing the long end of the curve?
I think absolutely. I know that some administration officials have previously been very critical of things like QE and suggested that there shouldn't be such interventions. But they've also made more clear that they want long end yields lower, and they've also kind of shown a sympathy with the idea that the ends justify the means. So I expect that next year topics like yield curve control, maybe even QE, may come back onto the radar in a very serious way. So I think that's why the yield curve will be very hard to play. I think they'll try to get 10-year yields lower. 30-year yields may still go higher, though.